Equity markets delivered exceptional results as South African markets were up over 10% for the fourth quarter and just below 27% for the 2012 financial year. However, the market remained a difficult place for active managers, and Cabot-Alletzhauser, head of the Alexander Forbes Research Institute, joins us on the desk to discuss the impact of a bearish and bullish market on the performance of active managers. Well, let's start with those performance surveys. What trends are we picking up, Anne?
Okay, I'm going to give you a cautionary. You know how I feel about performance surveys. It's like narcotics. They have their place. They're enormously effective if properly administered. But if they're done recreationally, all sorts of problems. So I put all sorts of cautionaries behind surveys, and let me give you 3 examples that came out of the year-end survey. Less than 30%, between 25 and 30% of equity managers outperform their benchmarks.
So let's just reiterate that number, less than 30% outperformed their benchmarks.
So it depends on whether they were benchmark cognizant or benchmark non-cognizant. We're these bad managers. Let's switch to the bond survey. 18 out of 21 bond managers outperformed benchmark over the course of the years. Are these guys all just miracle workers? Absolute funds, absolute return funds. Everybody beat their CPI plus benchmarks. Are these guys the miracle workers? If you read the survey and you only look at the statistics, that's what you'd come away with. And nothing could be further from the truth, and that's the problem with surveys.
Let's go to the truth as you see it playing out then. What is the reality in this environment?
Okay, what are the dynamics that really help you understand what performance is all about? First of all, what's the meaningful time frame? Okay, so every strategy has a duration to it when it becomes, it plays itself out. Now, one of the interesting dynamics that we face in South Africa is just about every equity manager has, maybe on the recognition that Alan Gray has done so well, they've all kind of moved into this wonderful value space. In fact, the bulk of our managers will now put their hands up and say, I'm a value manager.
But are they true value managers?
They will be true value managers. And that's why the bulk of them are underperforming right now, because the value strategy is fundamentals using just that basic criteria of relative value isn't working in this type of market. What does Alan Gray tell you? Their cycle to review them over is about an 8-year cycle. We're looking at the value kind of disintegration since February of 2012, okay, since February. So that gap that appears where those managers went out and bought resources and they started to underperform the industrials and financials so dramatically, there's about a 30% gap in there, starts to form in February of 2012, and it has continued up until now. That gap is still there. So are they bad managers, or have we simply looked at them over too short a time?
But do investors have enough patience? Yes, Alan Gray has done a lot of branding around looking over the longer term, but at the end of the day, these managers are being judged on 1, 2, 3-year performance.
Fine. If you don't have enough patience, don't buy a value mandate. There are plenty of mandates that are there actually aren't plenty. There are a handful of mandates that are in there that will be fairly resistant to different types of style phenomenon. And you can identify these mandates. Mix has got about 3 of these mandates they're in there that are just going to arbitrage out interesting opportunities in the market or look for low volatility. And those aren't quite as subject to these cycles. The cycle guys will give you the huge performance swings.
So does that mean that all value managers are going to give you the outperformance over a longer period?
No, and then you'll have to start slicing and dicing and trying to understand what actually happened. So that's one point. Let me switch over to the ALLB now, where everybody's a winner. And yet, bizarrely enough, a lot of these guys played the short end of the duration curve. And they were wrong. That was the wrong place to be. So how were these guys outperforming the ALLB? They were doing so by investing in something that isn't in the ALLB, credit. So is the ALLB the right benchmark? This is a fight I have with Andrew Cantor all the time.
So how does Andrew say he should be measured and the rest of the bond players out there?
No, I think Andrew recognizes that if we could create some sort of benchmark that captured that credit exposure, fine. But it's extremely difficult. We just don't have a viable benchmark. And so you're left to my interpretation, which is what we've tried to do. We've said, okay, look, we will provide a survey, but do not look at the survey unless you read the commentary that goes with it, because the commentary should guide you through the correct interpretation. But do you want me to hit the absolute return managers?
Absolutely, let's go straight to absolute return now.
Because these are the guys that look like heroes, CPI +3, +4, +5.
These are the rock stars right now.
They look like they were cooking. But if I had taken a strategic asset allocation benchmark that mirrored what they were actually holding, okay, in terms of their average asset allocation over that time period, and tried to see whether they could add value above and beyond that, none of them added value. None of them beat those benchmarks. So what's the problem here? Do I not have the right duration? Should I be using that CPI plus benchmark only over a 6-year period or a 7-year period? That's probably the right answer depending on the CPI plus target.
So it comes down to duration.
It comes down to duration. And so, but the answer is not that these guys are heroes. Because if you, like you've just described, happen to be a very short-term oriented person, and you looked at the results and you saw that actually my absolute return on those funds relative to the CPI plus was totally awful compared to other balanced funds.
But now the conundrum that the industry faces is that a lot of investors, retail investors particularly, will rely on these performance surveys to make their investments.
don't do it.
They do, so how do we move away from that? I mean, and that's the reality.
It's a terrifying
It's the only way that you can measure performance.
I'll tell you a worse thing that they do. It's not that they go in there and they say, okay, who's the best guy? They also say, let me pick a couple of the best guys, because that's got to be good. And I'm diversifying my risk.
Reducing your risk.
And what I'm literally doing is that I'm doubling up on the same bet. So what do? That's a very important problem. And what you don't do is use the past. I don't know how many times do we have to tell you this, guys?
You're going to tell me don't go on past performance.
But you can't.
But then Allan Gray wouldn't be where it is because you are looking at past performance for assurance of future performance.
Well,
that's
I
reality.
tell you what, if you believe that, you would never have invested in Allan Gray in 1998. In fact, they lost probably 50% of their clients by 1998. I mean, it was just a shocker what their performance was. And yet that was the year to go. So you want to really play your cards right here? Look at the bottom manager, be a contrarian. Remember, buy low, sell high. Works the same with fund managers, but no one has the courage to do it because they don't believe that's the fiduciary correct thing to do. But it's the same principle. You're just capturing a basket of shares that are low versus a basket of shares that are high. It's not quite that pat, but in
terms of general asset allocation right now,
where would I be?
Where would you be?
Oh, that's not fair. I just came in on a poll and I'm not a market timer. But I want to go back to another point. And I want to talk about the active passive thing of the equity managers. And I let these
we should all actually be going for indexes.
I let these guys get off the hook on the duration call. But the question that is certainly going on with a lot of consultants and a lot of trustees. In fact, I just came from a conference where I had a number of them ask me, should I fire, and I'm not going to name the name of that very famous fund manager who's at the bottom of the heap, but should I fire that bastard, for what he's done to my fund? And I think the real problem with the active passive debate is what people don't understand is once they get into that performance chasing, they go and they fire that son of a gun, and they've locked in that loss.
And at the end of the day, it was a timing issue.
And then because they've used that principle of fire the manager who underperforms, but buy the manager who's demonstrated that they're good, they bought this manager over here at the top of the cycle. So what you've done is that you haven't just lost the amount that you've locked in the loss. You've also lost in whatever gain.
The timing where you should have bought the outperforming fund manager at a different time period.
So the real debate about active versus passive has to do with once you get into the active chasing, that's the value destructive. What's interesting about the active manager, and this is something I really want to examine much more closely, is that there's something about what active managers do. And you might be able to duplicate it, by the way, passively. But there's something about what they do that lowers the volatility of the fund relative to the index. And therefore, for a bang for buck, in other words, on a risk-adjusted basis, active managers are typically fairly good, whereas if you follow an index, you get a lot of the volatility involved in that.
But if you're holding over the long term, surely you can see your way through the volatility cycle.
You know, we are so seduced by the notion of active in this country, and passive has had such little, ability to gain any kind of...
But judging from performance, shouldn't the opposite be true?
Well, exactly. Right now, by the way, active should be starting to perform, but now is when everybody's going to rush to passive because they're now absolutely convinced that there's no skill out there. And what I need to really wrap this up by saying is performance really has nothing to do with manager skill. It has first and foremost to do with the style of the manager and what the market is rewarding. And that in itself should be the determining fact, and the duration of what you're looking at, that other good point, and
so
the benchmark.
The caution
Have we got the right
I think it's
benchmark?
very important that we go back to what you're cautioning, in that you're going to, from the performance surveys, be in despair over the fact that your active manager is underperforming. You're going to make the wrong call now by cutting him loose. Rather, you've got to sit through this, and in that way, you're ultimately going to benefit, specifically because the value managers will have their day. Is that what you're saying?
It will. Remember, these are rolling windows that you're looking at. So this trustee came up to me today and he said, but their performance is horrible on a 3-year basis as well. And I said, well, guess what? If it's really, really bad in the last quarter, that's going to affect the 3-year number as well. So that doesn't mean that for the whole 3-year period that manager has been
underperformed.
Yeah, so you're looking. This is the other horrible thing about these surveys. They're rolling windows. And so it'll look like the manager is starting to get better, and then suddenly that underperformance that he had the year before drops out.
So what's your advice now to the active managers out there who are judged by these surveys, regardless of how, and you say disregard the surveys, don't look at them, the short-term nature perhaps gives you a skewed perception. The bottom line is that we judge our managers by this. So what do you say to the active managers right now who are
active managers in South Africa? For goodness sakes, start looking at other strategies and value. I mean, what is happening in the market is that you're getting this herding that's taking place with everybody sort of going into the same space. And then a few guys will be over here. You know the names. I don't mention the names. I don't mention the names. They're out here. They've made the right calls. They've been sort of following the thematic ideas in the market. They're global thinkers. They're watching what the foreign investors are doing in our country, which is what really pushed up.
And they're benefiting from the momentum.
And benefiting from the momentum, exactly. And so guess what? Next year, everybody's going to move over there. And I have this wonderful chart that I show goes back to 1999, and then it shows 1999 versus 2012. 1999, where we had this huge run of small cap growth shares, everybody became a growth manager. So there were like 3 or 4, there were 4 value managers left. Everybody had become growth. And then the markets collapsed and everybody went. Now we have exactly the opposite problem. So my commentary to managers in the active space is, for goodness sakes, offer the investor some options. Let them diversify.